Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Rehana, Earle and Earle Theochari.
Welcome to The Tax Factor. I'm Rehana, Earle.
And I'm Earle Theochari.
It's definitely feeling more autumnal, and we've heard a lot about tax at the party conferences ahead of the budget at the end of the month.
And hello and welcome to all of our new listeners. We're at the top of the podcast charts again, so no pressure.
Today, we're going to be talking about the Labour Party conference, the potential watering down of Labour's proposals to the non-dom rules, and the latest R&D stats. Earle, we're less than 30 days from the budget, and every day is filled with speculation as to what Rachel Reeves and the Labour government might announce. We're still awaiting to see what the impact will be on us personally, and I think organisations of all sizes are trying to understand what the implications might be for them too. And let's face it, the news hasn't been filled with many good news stories over the last few weeks, with a lot of doom and gloom about. Last week, the Labour Party held its conference, as we know, in Liverpool, with the Prime Minister and the Chancellor's strapline being rebuilding Britain. But the overarching message is still very clear that it's a difficult trade-off with hints of tax rises on the way. So, shall we talk about what we've been hearing?
Absolutely. So in terms of new policy, there wasn't much in the speeches given. One continued focuses on tax compliance and, as always, going after tax avoidance. It was announced during the conference that Exchequer Secretary James Murray has been made chair of HMRC's board. So in spring, we should expect to see a digital transformation roadmap being published, which I think a lot of businesses will agree and individuals is very welcome. So Murray's focus points for HMRC are reducing the tax gap, modernising and improving customer service, and it seems they've also been on a recruitment drive. And whilst there has been some progress made in that recruitment space, it does seem like there is quite a big gap to fill to get to their target of recruiting an additional 5,000 compliance staff.
Yeah, and I think that's a really important point, Earle, because in previous episodes, we have raised the issue of the quality of HMRC's service. And at the moment, it looks like it's still on a downward trend, with telephone helplines continuing to receive heavy criticism, along, it seems, with people finding it difficult to understand and navigate the HMRC guidance, which is published on the website, as well as dissatisfaction with web chat. And in fact, some recent reports suggest that the experiences with the HMRC website are worse than in 2023. A recent survey, which was led by the annual Administrative Burdens Advisory Board, which surveyed 10,000 businesses and tax agents, showed a high level of dissatisfaction with HMRC's helplines, with nearly 2/3 of agents and businesses describing wait times for responses to phone helplines as poor, which is a significant deterioration on last year's 43% of dissatisfaction. And when it comes to the website, many respondents found the HMRC guidance difficult to navigate, preferring to actually get guidance from other websites, so accountants' websites or paid advice lines. And so there's a clear message that what people really want is information in plain English with a lack of jargon. There also seems to be a lack of confidence in the Making Tax Digital creating any savings for both individuals and practitioners alike, with just 5.4% believing the introduction of Making Tax Digital would save them money and only 7.3% saying they think it will save them time. In summary, I think there's still a lot that the government needs to do to get HMRC on track, particularly if they're relying on HMRC to close that tax gap through compliance.
Definitely, but another way that they could potentially close this gap is through taxes. So there were plenty of calls for tax rises on the wealthy, with widespread expectation that the Chancellor will announce increases of some sort on either capital gains and or inheritance taxes, as well as the tax treatment of pension contributions. At a separate meeting, an MP called for a wealth tax of 2% on assets over 10 million, saying this would raise up to £24 billion a year. Rachel Reeves didn't address this question directly or any other questions directly about wealth tax on the conference floor. But in a pre-conference interview with the Sunday Times, Reeves dismissed the idea, saying, and this is a quote, "I'm not looking at creating some new tax or a wealth tax."
We might not see a wealth tax in the near future, but the big news, certainly in my world, is the ongoing discussion around the changes to the non-dom tax regime. We've covered this in many previous episodes since proposals or changes to the current rules were announced by the outgoing Conservative government. And Labour's proposals went slightly further. And in April, they assessed that their additional proposals, which included the removal of protection from UK inheritance tax for foreign gains and income held in trusts, as well as scrapping the planned 50% discount for non-doms bringing foreign income to the UK in 25-26 as a transitional year, would raise another £1 billion. During the Labour Party conference, Reeves reaffirmed her commitment to end the non-dom tax loopholes. But the day after the conference, there were plenty of rumours that the plans, in the words of the Financial Times, were to be watered down. Now, this is on the basis that there are fears that some of the measures may fail to raise the money because the wealthy will simply start to leave the UK. And quotes coming out from government officials included, in quotes, "We are looking at the details of our proposals and we will be pragmatic but not ideological. We won't press on regardless, but we are not going to abandon this completely." But reports state that estimates due to be released by the OBR may suggest that the plans will actually fail to raise the revenue that Labour have anticipated. As a reminder, Labour pledged to raise $5.2 billion from reforms to the non-dom regime, which would be a significant plug of the $22 billion that they've talked about. But what we're seeing is that those that have the wealth will simply plan accordingly and will move to more favourable tax jurisdictions. So not only do we have the lost tax revenue, but of course a knock-on impact of lost spending and other contributions that these individuals make to the economy in other ways. So for some, if the plans are watered down, which hopefully there will be some relaxation specifically for inheritance tax and on the trust point, these new announcements, of course, they do provide some potential good news. But the question is whether or not this is too late on the basis that people have already made the decision to move and started that process really of leaving the UK to a more favourable regime. So I think we're going to have to wait and see what the final announcements are and whether, of course, they will tip that balance in the right direction for those that are thinking of upping sticks. I think ultimately, though, and I think everyone would agree with this, what we're really looking for is a fair system that is internationally competitive, that obviously drives wealth to the UK and investment, as well as encouraging the right talent to come to the UK. I think many of us see, the changes to the non-dom regime, which definitely do need an overhaul, but as a chance to really properly reform it and get it right. And whether or not Labour are really kind of achieving that with their current proposals, I think is really up for question. In fact, our CEO, Nimesh Shah, said on Radio 4 last week in a fantastic discussion with Nadeem Zahawi, that the government actually, what they need to do is delay the introduction of the rules and have a proper consultation and not push this through at any kind of political agenda. They need to give serious consideration to their plans, to the length of the foreign income and gains regime, and actually they need to remove the cliff edge impact for trusts and inheritance tax and take a proper look at that 10-year inheritance tax trail. There'll be no doubt that there's lots more to come on this as we approach the 30th of October, and I think we'll all be waiting with bated breath to see what comes out over the next few weeks. But with that, Ellie, what else did we hear and what can businesses expect to see?
So many attendees from business representatives at the conference, but business taxes weren't really the main talk of the conference. So James Murray spoke at a fringe event about the promised business tax roadmap, and ministers talked about the government's planned reforms to the apprenticeship levy specifically. There was little discussion on corporation tax, but Rachel Reeves has already repeated her commitment to not push it above the current 25%. We saw the news of the French PM announcing a temporary tax on the profits of big corporations in order to get its finances back on track. So this meant raising the rate from 25%, so the same as the UK, to 33.5% on companies with a turnover of €1 billion, which they think will raise €8 billion. So this is perhaps something that Labour could also look into. And one point that has been made clear, and this is certainly by private equity investors, is that raising capital gains tax shows a lack of support for entrepreneurs. BGF, the UK's most active PE investor, issued a warning that they would scale back investment in the UK if capital gain tax were to increase. So whilst not officially targeted for a rise, this does remain one of the few major taxes that could see an increase on the basis that Labour ruled out increases to income tax, national insurance, VAT and corporation tax. Often share incentives which may be taxed at capital gains tax rates are used to supplement low incomes for startups and SMEs. So increasing the rates is penalising individuals who sacrifice pay at the beginning to grow their companies and then get the rewards later if their businesses become successful and they are, subsequently able to sell. Alongside this, there were lots of other things at the conference, so green taxes, tax relief for creative industries, but not much on any new changes to R&D tax credits, which for me personally was a welcome relief because there's been so many changes. Speaking of which, and against the backdrop of members of an R&D consultancy being arrested by HMRC, I wanted to very briefly touch on some of the latest R&D stats. So although there has been an increase in the expenditure of claims being paid out, there has actually been a decline in both the SME and the large company RDEC scheme claims. So R&D claims have fallen to just over 65,500, which is 23% lower than the year before. This isn't necessarily surprising given that many SMEs have either been put off claiming, many are still under inquiry, so wouldn't necessarily be claiming anyway right now. And many of those kind of cowboy R&D firms have been shutting down all over the place. So those who were possibly putting through, let's say, less than satisfactory claims aren't really around. So there's less claimants generally. RDEC claims with a large company also fell by 9%, despite the 7% increase in expenditure. Again, this isn't necessarily surprising given that in part, the relief of RDEC has become more generous. So it's gone up from 13% to 20%. So an almost identical claim in terms of core expenditure would actually gain more for that company in any case. As with almost every year since the schemes have been in place, the majority of claims have mainly come from IT, manufacturing and scientific and technical sectors, which accounted for about 67% of R&D claims and 70% of RDEC claims. This is similar. Again, majority of the claims come from London and the Southeast, but that's not surprising just because of the concentration of businesses. And finally, in terms of fraud, as we've spoken about on previous episodes, HMRC have really been cracking down. They don't necessarily have the stats, and sometimes the stats don't necessarily tell the entire story. However, the fact that there are a huge number less claimants than there were before would suggest that whatever they're doing is working to some degree in terms of stopping the level of error and fraud. So that's always good.
Yep, that sounds good. Reducing fraud overall. So something is working in HMRC. To finish off then, we're going to touch on Kemi Badenoch's claims this week, where I think she's caused a bit of chaos with the claims that she's made around maternity pay, which she has subsequently backtracked on. In quotes, Kemi said, "Maternity pay varies depending on who you work for, but statutory maternity pay is a function of tax. Tax comes from people who are working. We're taking from one group of people and giving to another. This, in my view, is excessive. Businesses are closing. Businesses are not starting in the UK because they say that the burden of regulation is too high." My personal view is I think Kemi might be a bit confused about how the tax system works, because normally you do take and give to other groups. But having said that, as we know, this has caused a widespread backlash, particularly given the OECD report, which ranked the UK as the 9th lowest of 33 European countries for full rate equivalent paid maternity leave. And including childcare, the UK, I am sad to say, ranks 4th lowest in Europe.
Yeah, that is actually, those are awful stats coming out of that OECD report. And I'm not surprised that she's backtracked. Particularly, it's not like people on maternity leave are often rolling in cash. So there was also commentary from Kemi that there was a time, there was no maternity pay and people still having children. I can't speak to kind of the latter part, but a form of maternity pay has been in place since 1911. So it's not entirely clear which timeframe she is referring to. And for those that perhaps aren't in the know, and I didn't actually know either, in the UK, if you're up to date with your national insurance payments and you're an employee of a company, you're entitled to 6 weeks of pay at 90% of your full salary. And after that, you get £185 a week, which is paid for by the government after taxes that you and every other taxpayer has contributed. Your employer doesn't have to actually pay anything. However, if they are a small business, they can actually reclaim 103% of what they pay you, and therefore they make a small profit to help with the administrative costs of administering the maternity pay. Your employer is obliged to facilitate your return to work after that 12 months or 9 months if you only take that. But you can see that is not a widely generous offering for new mums or new parents.
Yeah, and thank you for spelling that out, because I think it's really important, actually, Ellie, and probably not a well-known fact, certainly that last piece. So that is all we have time for this week. We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever is most convenient. We record and release them in less than 24 hours, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review.
We've just released a new episode of our sister podcast, Brave Business, presented by Declan Curry. This episode is about the business case for sustainability. Everybody talks about it, but what do you actually have to do beyond the cliches, and how can you prove that you mean what you say? Joining Declan, we have Jim Brown from Blick Rothenberg, Charlotte Pumford from Vivo Barefoot, and Paul Lewis from Seismic. If you're interested in how businesses are now approaching the topic, it's a must listen. Like The Tax Factor, it's available on all podcast platforms and on our website. Next week, Matt Crawford is back.
But from us, it's goodbye and have a fantastic weekend.
Goodbye.
That's The Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.